Rhynhardt, if we start with the second quarter GDP numbers, more or less in line with expectations, probably depending on who you are. But the fact is that the mining sector was a big driver there, but really off a low base, a bombed out base that we had in the first quarter. And the question is whether this recovery will be sustained in the third quarter, given the drama, the tragedy that we've had so far. Unlikely.
Yeah, certainly. If you look at the number, 3.2% versus I think expectations of around 3.3%, so very much in line. You did rightly point out that the comparative base for mining was quite soft because we had quite a lot of safety stoppages, especially in the platinum industry and to some extent in the gold sector. So I think mining output was up over 30%, I think 31% for the second quarter, which clearly won't be sustained going forward. The other sector that stood out to me was manufacturing, down 1%, and that's probably a slightly better indication of what's actually happening in the South African economy at this moment on the ground. So our run rate for the first half of the year I think is around 2.5%, which I think if you had to say we were going to be at such a low number maybe a year or so ago, it would have come as like quite a shock. So it just shows you how much South African GDP expectations has been lowered. I don't think the second half is going to be a lot better, and I think we'll probably end up the year at maybe about 2.5% if we are lucky, because as you did point out, mining output will probably not have the same performance, certainly not in the third quarter. Is it a weak enough number to have another interest rate cut? I think it's highly debatable. I don't think so. We did certainly get a very good inflation number, but I think probably we actually won't move lower on like interest rates. But what is fairly clear is that growth is probably low enough to keep rates very, very low for quite an extended period.
Rhynhardt, staying with the mining theme, we had fourth quarter results from DRD Gold in a completely different operation from your typical deep underground gold mine. It's a surface operation, reclamation, etc. And this is really what Neil Pretorius is going for: low margin, higher margin, lower risk, and he's far more upbeat about the future. But the stock declined by 4%. Is this profit taking after the strong run that the stock has had relative to the sector so far this year?
Look, it's quite hard to say what the short-term move means. I think the entire sector didn't have a very good day. But if I look at DRD, I think that their numbers were broadly in line with expectations. Maybe the operational earnings wasn't that great. I think they made about 86 cents a share for the full year to June 2012, of which 16 cents was in fact from a deferred tax asset. So operational earnings perhaps wasn't that great. But having said that, though, I think DRD is certainly a company that has done very, very well the last 2 to 3 years. I think there would have been serious question marks maybe 2 or 3 years ago whether DRD would actually be like around in a couple of years' time. They were mining very deep operations, their costs were out of control, and now, as you rightly pointed out, I think they have certainly de-risked the business. They mainly mine surface operations. It's a lot less risky investment, and I think Neil and his team have certainly done a very good job.
If we look at Pan-African gold and platinum, and to an extent a similar theme, working with tailings, so not a deep underground operation necessarily. Last week on Friday, late Friday, announcing a 700 million rand rights issue, and today a very upbeat trading update.
Yes, definitely. I think it must be one of the best performing small cap mining shares on our market. Very good set of numbers. They actually do have a relatively deep level mine, although not quite as deep as the old Blyfro from DRD. They mine the Barberton operations, but very good set of numbers. I think going into next year is probably going to be a very good year for them again, because from like Evander Gold, they will get all of those ounces. So gold output for them in the 2013 financial year will be more than double what it was this year. They're starting to mine a little bit more like platinum also, and we really, really rate the management team very, very highly also. So the PE multiple is about 9 times. There's a lot of volume growth, and it is certainly one of the junior mining companies that we tend to like quite a lot.
Very nice. Hi, it's Samantha here. Let's shift focus to the construction space, because Merwe and Robert's out with results tomorrow, and we're looking at a stock that's fallen from almost 29 Rand in April to around just over 22 Rand now. What are you looking out for in those numbers? Because they have forecast a better loss this period than the previous year, but overall, is it a space or is it a company right now that has any green shoots going for it?
Look, I think a very keen focus will be on the strength of the balance sheet. It will be the first time that they will be reporting a set of financial results after their rights issue. So I think there will certainly be a very keen focus on free cash flow, what are the margins like, etc. The second thing would be what's the state of the order book. It's fairly clear that in the South African space there are, I think especially on the mining side, to which there are very exposed to. They are certainly losing some like contracts there. They were the contract miner at Marikana, so that is a fairly significant loss for them. So they clearly have to find like another project there to kind of make up that part of the order book. Some of the international operations, I think they still have a loss-making like project in like Australia called the Gorgon Growth Project. I think that's a liquid natural gas project which they made quite substantial losses on. So I think the market would like to see that the losses are now something of the past, and that the order book going forward is maybe a lot cleaner. I don't think there's a lot of green shoots in the short term for the industry. Yes, the shares are certainly down a lot. It's been one of the worst performing sectors, and I don't think the equities across the board in the construction space is perhaps that expensive. I think you might just wait for quite some time to maybe realize value or like unlock value in the near term. And I think that most of the companies are still fighting for like contracts. Margins are like paper thin. So I think it's going to be another fairly tough 6 to 12 month period for most of them.
Rhynhardt, thank you. Rhynhardt Roodt is an equity analyst at Investec Asset Management. He's in Cape Town.